Welcome to Stocks in Translation, broadcasting from New York, New York. I'm Jared Blickery, your host, and once again, I have the people's voice, Sydney Freed, by my side. First, please like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. Today, we are welcoming back Tom Sosnoff. You know him as the founder of Tasty Trade, as well as the founder and current CEO of Tasty Live. He also created, then sold Think or Swim platform back in the day, and before that, he was a floor trader at the SIBO, or the Chicago Board of Options Exchange. So we are in good hands here. And today we're going to be talking about options with some general market talk mixed into it. And our phrase of the day, that is implied volatility. It's the mathematical foundation of options trading. We break it down for beginners. And this episode is brought to you by the number 0, as in 0 days to expiration, what 0 DTE means for retail traders. And Tom, we're going to get into the nuts and bolts of options talk in a minute, but first I just want to get your big picture overview of the markets right now. February was not the greatest month for risk markets in general.
No, I mean, the markets probably was a little bit, heading into February, the market looks pretty good, but February traditionally is one of as you get towards February expiration, which is the third week in February and beyond into the first week in March or so, is traditionally a very, let's call it, it's one of the most bearish, seasonally, it's one of the most bearish periods. But generally speaking, this market we got a little complacent. I think the market got a little full of itself, and we caught everybody long. I think that's the easiest way to say it.
Yeah, I like that. Spoken like a true trader. This kind of segues a bit into our phrase of the day, which is implied volatility. So implied volatility, or IV, measures expected future price swings in a stock or option, and a higher number means bigger expected moves. Lower numbers suggest calmer markets, and we've seen this kind of move to the upside here. So tell me how you use implied volatility in your work. I assume it's a lot as an options trader, but you tell us.
Well, the one thing, Jared, that I'm very happy you're doing is talking about implied volatility, because I think it's been many decades since anybody in financial media has covered the term implied volatility. So kudos to you guys.
Thank you.
I'll simplify implied volatility for you just down to basically one sentence. Implied volatility it simply means expected move. Another way to interpret implied volatility is just to say expected move. So essentially, the higher the implied volatility, the easiest way to look at this is the higher the implied volatility, the larger the expected move, which means when you think of things opportunistically, obviously, if an underlying is going to have a wider expected move, it's more interesting. If you're bullish or if you're bearish, whatever direction, because expected move doesn't actually know which direction. So it just means that plus or minus, it's going to be a bigger move, which means more opportunity. So the higher the implied volatility, if you're a premium seller, it's better. And if you're just a directional trader, it's better. If you're an opportunist, it's better. So for self-directed investors, and I guess institutional investors as well, higher volatility means, more action, more fun. And that's why you're seeing the huge option volumes we've been seeing lately. That's why you're seeing the huge futures volumes. And that's why you're seeing just all the general activity in the markets.
Tom, it's Sydney here. So how does the average investor use implied volatility to take advantage of it? What's your biggest tip?
So the implied volatility on its own, if I told you, for example, if I said to you the implied volatility of Tesla was 74, right now, you would say, I don't know what that means. I have no context around that. Like if you said to me, Tom, the implied volatility of IBM is 42. I don't even know what that means. And I've been trading IBM for a billion years. So just giving somebody the level of implied volatility doesn't mean anything. It has no context around it. But so what we do is we created this indicator now, which is now, by the way, industry-wide. It's not just us. But it's called implied volatility rank. So we rank implied volatility from 0 to 100 so you can have context around it. Like, for example, right now, the implied volatility in Tesla, just because it's an actively traded stock, is let's see, it's 74, but the IV rank in there is 77, which means that on a scale of 1 to 100, it's very high right now. So if you wanted to trade Tesla because you thought it would have a big expected move, or if you want to trade Tesla because you want to sell premium in there, it is an extremely interesting play, because anything over 30 with implied volatility rank is considered to be hot. And that gives you context.
And it sounds like this might be useful even for trading outside of options. Would you use this, for instance, just going long the stock or shorting the stock or something
Sure.
on a shorter time frame?
Of course. Let's say you picked a stock, just any stock. Like let's say you picked a stock like Intel, or you picked a stock like PLTR, any stock that's out there. If you know what the expected move is because of implied volatility. Now, not every platform in the world has this because they're not all that, I guess quantitatively or statistically advanced or probabilistically advanced. But
Mhm.
most of the good trading platforms, most of the platforms that have derivative products built into them, they all have expected move built into the platform. And the reason that's so good is let's say you were trading something, for example, like PLTR, just throw any name up there. If you know what the expected move is, you know where you can place your mental stop on the way out, and you know what a reasonable target is if you're bullish and you buy it and you expect it to go higher. So for example, let's just
Mhm.
say after the sell-off here, you want to buy some PLTR, and the expected move in PLTR over the next 30 days is $12. Then at least you have a target price of what it what it may hit, what the market's saying it may hit, and you might set your target, you might set your own exit at 50% of that, at like $6, or at $9, or at $12 if you want. But at least you have context around where to set your closing price.
I love that because I focus on risk management here a lot. And I was listening to one of your shows here on Tasty Live earlier in the day, and this is a little bit of a segue, but I'll bring it around. One of your viewers was asking you if it's not for underlying financial fundamentals, what do you believe determines the future trajectory of an asset? And you kind of gave this long winding response, but it gets to your approach to the markets, and that's what I'm really fascinated here because you don't really, I don't want to put words in your mouth, but you're not really a technical trader or fundamental trader or macro trader. Can you describe who you are?
Yeah, I'm a weird trader. So I'm not your normal kind of market enthusiast. I'm an efficient market theorist. Even though I understand positive drift and I understand, ultimately what makes markets go higher. In the short term, I believe everything is priced into the market. So I believe whenever you look at something, don't tell me the macro story because I don't really give a damn. Don't tell me your fundamental story about how great this company is, because if you know it, then everybody else already knows it, that it's built into the stock price. All I really care about is my own subjective view of price extreme, whether I think a stock is too expensive or too cheap, which is nothing except my own view.
Mhm.
And then I also care about implied volatility rank because I'm a premium seller. I want to know where to set up my short calls or my short puts or my put spreads or my call spreads. And I want to set up targets for myself over around expected move. So really, really good option traders who are mechanical about this business trade around expected move as kind of just different levels. And they also understand kind of, some people are trend traders. If something goes up, they'll buy it. Other people are contrarians like me. If something goes up, we sell it. If something goes down, we buy it. So however you want to set up your own version of price extreme, what matters to me is where those expected moves come into play. And that's how I look at trading. I'm an opportunist based on essentially implied volatility.
Tom, what are some other strategies you're working with right now as we see this increased volatility?
Well, the cool thing is that in the world of strategic investing, now remember, when you talk about strategies, if you're just a stock player or just a futures player, you're essentially everything's very black and white. You either buy it or sell it. There is no strategy. If you're trading digital assets like Bitcoin or ETH or anything else, there's no strategy. It's all just buy or sell passively or aggressively, whatever. But if you're an option trader, you're strategic. And the beautiful thing about that is that none of these strategies, Sydney, really change at all. Like going back 4 decades, all the strategies are all just, it might have different names today, but they're all just the same variations of the same type of trade. At Tasty, we love to say that we're just the financial version of like a Taco Bell, where they have like 5 ingredients and they put it into like 75 different, different food groups. We have like 5 different strategies and we put them into like 75 different complex discussions and strategies. But it's really it's really not rocket science. And either something is very vertical in nature or something is horizontal in nature, and that's it. And for me, like I said, I'm a premium seller, so I like to sell puts to get long. I like to sell calls to get short, and variations of those. There's lots of variations.
Yeah, you talk a lot about the mechanics here, and there's a lot of statistics and math involved in some of this, but there's also a high degree of subjectivity, and you're relying on somewhat on your gut and your intuition here. How do you carry that over as a beginning trader? How do you get your feet wet before you have that background?
Well, the first thing, Jared, is you stay small, obviously. So as long as you can keep your size small and your ego in check, you don't really have to worry that much because if your size is very small, the risk is very small. Most people, the way genius fails is when you get too big. And so if you keep your size small, that's really the key to learning, is just to experiment with lots of different things. And you also have to realize that sometimes you are going to be right. And you're going to think of yourself, oh my God, I'm good at this. And other times, no matter how good you are, the stock wins. Like the stock wins a lot too. So, this is a very fair level playing field. This is a very fair game, no edge either way. And so sometimes the stock wins and you got to just give the stock credit, and sometimes you win. So rather than thinking, oh man, I know something, just accept the fact that it's your mechanics, and you just have to experiment with lots of different underlines. You have to experiment with lots of different strategies. You have to experiment with just kind of, I call it strategic indifference. And I think that's the best way to learn. The best way to learn anything is by doing it.
Acceptance and humility, two great keys for beginning traders. All right, we got to take a short break here. Coming up, we're going to be talking more about options, the zero-dated kind, and a runway battle pitting institutional traders against the retail masses. This episode is brought to you by the number 0. That's 0 as in 0 trading days to expiration, which refers to a style of trading options on the very same day that they expire. Now, back in the day, you had to wait for Fridays to do this, but the week has opened up to other options in recent years in expirations. So, Tom, tell us what is this a big deal for traders? This kind of evolution over the last few years, it's brought a lot more opportunity. I assume some risk as well, but are they even liquid now, these other days of the week?
Well, it depends what you're talking about, but generally speaking, yes. I mean, the zero DTE options, especially in the S&Ps and the E-minis, are as liquid as could be. And if you talk about certain, equities on the weeklies, they're extremely liquid too. And even if you get into some of the futures options that expire on like a Monday, Wednesday, and Friday, the answer is yes, they're very liquid. So the bottom line is, when you get into the 0 days, and we're talking, most of the 0 days trade in the SPX and the SPY, yes, they're as liquid. They're water. I mean, they're essentially the most liquid products we have.
Tom, do you think most retail traders who are trying zero DTE really understand the risks involved?
No.
Thank you for being honest.
No, I don't. It's what, Sydney? It's not that they don't understand the risk as much as I don't think they realize the zero DTs are very different than trading anything else. Zero DTs are incredibly unforgiving. Like if you do a trade right now and you're 30 days out or 45 days out, you have a little wiggle room. You have time to make an adjustment. You have time to maybe, go save the trade or salvage it or tweak it, whatever it is. If you're in a zero DT trade, and I should preface this by saying we've done almost 100,000 hours of research on zero DT trades. It's insane. And if you're not like familiar with some of the mechanics, I'll just go through it really quickly. Like if you try to put something on in the morning and hold it to the afternoon, it's almost mathematically impossible to be successful as a premium seller. As a premium buyer, maybe that works a little better for you. But we find that if you're trading zero DTs, it's more for the engagement. It's more for the I would say the engagement. It's more of a 50-50 game. And you have to recognize that. And so I think, especially for new traders, they sometimes trade zero DTs too big. Like it should not be more than 5, 10, 15, or 20% of your net lick, no matter what. You should never be bigger than 20% in the zero DTs.
And just to clarify, if we're talking about premium sellers here, you're writing options, and in theory, that can have unlimited risk. I'm really interested in this study that you did. I was reading a little bit about it. You studied options over 20 months. You mentioned a very large number of trades, and you were telling us about how that varies. Some of the edges vary with the time of day. Can you expand on that a little bit more?
Well, Tasty's a think tank, and so we have mathematicians that all they do is crunch numbers on zero DTs. It's like incredible. We run, I think, 60 hours of research a day. Most of it's on zero DTs, so it's kind of nutty. And we just look for like really there's no such thing as edge. So we look for like what we call like a mechanical optimization. Like at what time is the best time to get out of the trade or where's the best point in the decay curve? And if you're buying something, what's the best time to buy it? That kind of stuff.
We want to move on here. We have a very special option segment that we're doing as part of our Trade This Way, and this is sponsored by Tasty Trade here. So let's get into it. Tom, we've been talking a lot about options today, but we want to focus on some specific names. And we were talking before the show about Tesla. You have some ideas there. It's been a very volatile stock this year, down considerably this month by the end of February. So what opportunities, any trades that you see there that are interesting?
One of the things that I think is important is that, first off, Jared, we always want to trade things that are the most liquid underlyings. And the two most liquid underlyings have had a pretty wild couple of days here. Tesla's gotten rocked, down, I don't remember exactly what the high was, but it was like it's almost down 200 points off its heights. It got to below where it was at the election time. And the other stock that got rocked is Nvidia after post earnings the last 2 days. And so what you've seen is these are the two most actively traded equities with respect to options. Tesla trades like 3 to 5 million contracts a day. Nvidia's been trading 5 to 7 million contracts a day. So the first thing we have is the two most liquid underlyings in the world, equity-wise, are totally in play for individual investors right now. So I felt it was kind of best to, wherever there's the most liquidity is the best thing to talk about because that's the least amount of theoretical give up and the most efficient markets. So, you could pick your poison, Nvidia or Tesla. It doesn't really matter to me. They both gotten killed. But in the case of Tesla, on a percentage basis, it's down a lot more. And I'm not, I'm not going to make this into a political discussion or whether or not, you love Elon, you hate Elon or whatever it is.
Sure.
But if you're just looking at the stock and you're looking at it opportunistically, it's dropped a lot. And for example, tying in what we talked about before, the expected move in Tesla by April expiration, okay, which is just under 50, I think it's 48 or 49 days from now, is the expected move is $50. The stock is trading at $285 and with a $50 expected move, which means that if you thought Tesla was maybe a bit oversold or oversold, or however you want to think about it, you could go down $50 and you still collect $7 and change for selling the 235 puts, which is a huge premium. When you think about it, if you sold one put, you'd collect, let's just say $750. The amount of capital you'd have to put up to equivalent to do a one lot in Tesla is about 20% of the price. The underlying are just under $6,000. Let's call it $5,500. So it's about, a 12% return potentially for, 49 days with a probability of profit you're talking of just around 80%. So when you start to think about options probabilistically like that, okay, well, I've got an 80% chance of making up to, 10 to 12% over the next 48 or 49 days if I was bullish at Tesla. Those are the kind of things that we think about as opportunistic option plays. And you could have said the same thing in Nvidia. Nvidia dropped from almost 130 down to 116 it traded this morning. It's higher now, like 121, 122. But here's a stock that kind of dropped well over 10% in 2 days, made with a very high implied volatility. It's moving all over the place. And maybe I can generate a 5, 7, or 10% return at the expected move with an 80% probability of profit, in the next 45 to 50 days. Those are kind of interesting opportunistic plays.
And Tom, I want to ask you how, getting back to risk management for a second, how you manage your trades. Let's say a trade that you put on in the options market might be Tesla, might be something else, starts to go against you. Do you then look to put in an offsetting position? Do you just get out entirely? You've been in the game for a long time, so I imagine you have a lot of different options to do, but how do you manage that?
It's a very fair question because most people get this question wrong. First of all, it is very difficult to manage something that you can't control. And let's understand this. This doesn't go just for trading. This is about entrepreneurship, life, business, and everything else. In life, the things that you can control, that's where all your decision-making comes into play. That's where all your skills are, things you can control. If you sell a put, for example, in Tesla, or you sell a put in NVIDIA, that's the decision that you can control. You do that based on subjective price extreme. You do that based on implied volatility. You do that based on lots of reasons. However, if that stock starts to go against you, okay, now you get concerned. The first thing and the only thing that everybody can protect themselves on is by staying small to start with, because that is your best risk mitigation. Just stay small. But beyond that, yes, I would do exactly what you said. I would sell the offsetting side. So if the stock starts to go down, my put starts to lose money, I turn around and I go sell the offsetting call.
Tom, I'm going to be real with you. Options scare me. So we have 30 seconds left. What's your number one piece of advice for someone who's just getting started in options trading?
You have to get that out of your head that they scare you. Every financial instrument, and you need to promise me this, Sydney, every financial instrument is exactly the same. Whether you're trading stocks, options, futures, I don't care what it is. Every instrument, they all work essentially off the exact same model, and they all have some theoretical equivalent to one another. There's no difference between trading a stock, an option, or a future. So you have to get the idea that what scares you think is the leverage, but you're not thinking about it from the opportunistic side or from the probabilistic side. And I think that as soon as you jump in, your opinion of all this is going to change instantaneously. Just jump in. Close your eyes, hold your nose, and jump in.
I believe you, Tom.
I'm going to hold her hand.
You made me a believer.
All right. Tom Sosnoff, really appreciate it. Thank you for joining us here today. We have wound things down here at Stocks in Translation, so be sure to check out all our other episodes on the Yahoo Finance site and app. We're also on all your favorite podcast platforms. You know what they are. We'll see you next time. Thank you for watching.